Okay, we are live, is what I'm told. So let's take a look at this market here. Today is Friday the 13th, August, Friday the 13th, and I guess we have audio today too. What a nice treat that is. Basically, when it comes to looking at the market, whatever I said yesterday is what remains intact. And I'm kidding, but it's just a reference to obviously the real slow market that we saw today. Very light volume, one of the lightest volume days we've seen in a while, and the market came up to that declining 50-day moving average, and which is right now at 109.72. You can see in the lower left-hand corner of the screen, or hopefully you can see that. You should be able to. Let me just pull that up a little bit because I'm not sure you can quite see it. But 108.92 is where we see the 50-day moving average on the SPY, and we had a very difficult week for the market. We had been positive for the year coming into the week, and now we're down about given today close to 3% year to date. The month to date numbers, which Russ Masiri pointed out to me yesterday, I had been using the closing numbers from July actually. So those numbers that I've been tweeting at the end of the day, no one noticed or no one bothered to mention, and I didn't notice it until yesterday. So those will be up to date. But month to date, the Russell 2000 is down in excess of 5%, 6% after today, and we're in a difficult market environment, and that occurred very quickly from this place where we were extremely cautious up here because it had been this prior resistance and the basis of the lower highs that are still now intact on the weekly time frame. Like I said this morning, if you're a longer term investor, you really should be concerned about this market here. This is not the type of picture that you want to be buying into in your 401ks and that sort of thing. In fact, I don't like to give advice to investors and people with 401ks, but when a chart looks like this, I think you're better off, much better off with long-term money in cash. Now, we know that we had that death cross that occurred with an amazing buy signal just about 4 weeks ago that kicked off this most recent rally. That rally obviously has been nullified by taking out this low, and now that low near the 109 level, which is approximately equal to the 50-day moving average as well, is the area that this market has found resistance the last 2 days. That is not a good sign at all. The only thing you could read into maybe positively is it was light volume today, but again, only price pays, and we were down once again today. We're down 0.3%, and we're below all these moving averages. These moving averages are declining. What I found, and I was saying this I think to subscribers yesterday, is that a lot of times you get that death cross and then the market rallies, but if it takes out that prior low from where that death cross, as they call it, occurred, then you're going to see a bigger decline generally and really a confirmed bear market. So what would that mean? I think that would mean, as we know, we've seen that this on the weekly time frame, that the rally that occurred from the 2009 lows to the highs this year found support at the 38.2% retracement level. And when we get down there, and it's still quite a distance away down at that 100.5, 101 level, but when we get down there, maybe we consolidate a little bit, and then we break down probably pretty quickly to the next level, the 50% retracement, because there's not a whole lot of trading that occurred in here. So, as they say, markets have memory, price has memory, and the memory is not very strong for the bulls in here. So there could be a little vacuum that the market falls down through when we get there. So anyways, let's focus on where we are now and what this picture looks like going forward. Next week, the important thing for this market, if it's going to stand a chance to recover, is going to be to get back above that 109 level and hold on a closing basis, at least for a couple days, above that 109 level. We are realistically, just breaking the midpoint of what has been this bigger range of basically 105 to 113. That's been 104.5 basically, 104.5 to 113. We've just broken really the midpoint of that, and the other markets such as the financials have gotten down to the equivalent basically of the low end of that range. The semiconductors and the Russell 2000 are all kind of pretty much at that bottom end of the range that would essentially, if you were comparing apples to apples, that would be equivalent to about 105 in the SPY. So the spiders have been holding up a little bit better than the rest of the market, but it seems as though the rest of the market might be ahead of the S&P, and that the S&P will follow it, the rest of the market, that is. So 109 is going to be an important level next week. If we can't, I think, pretty quickly get back above that level, then it's likely that we will, this market will succumb to further pressure and come down and at least test that 105 level, and then we have this brief little area where we had broken that 105. But 105 is a bigger level. Had been a bigger level going back to even the fourth quarter of 2009. So really, longer term investors, this is where you really have to be basically on high alert that we could be heading to a bigger, more protracted downtrend in this market. I don't want to make predictions because the predictions aren't what pays. What we want to do, though, is we want to assess, number one, what's most likely to occur. Now, what's most likely to occur? Nobody has a crystal ball, which is why predictions are completely useless. But we want to know what's most likely to occur, and then number two, be prepared for anything. Have a backup plan. On, I believe it was Wednesday, I said that I thought that the S&P 500, Wednesday night I said, it seems as though after this big decline, down to the 50-day moving average in this prior support, it seemed most likely that the market was going to try to consolidate here, and we would have a quiet consolidation day on Thursday. But that we didn't want to be long because we were still below that declining 5-day moving average. That was at the end of the day on Wednesday. Of course, we gapped lower and immediately rallied. And today we had pretty much, I believe we had what's known as an inside day. If you're not familiar with that term, let's just take a look and confirm that. Yesterday's high was 0902. Today's high was 0896. So we did have an inside day, and that's just, or other people call it a narrow range day. What it means basically is today's high was lower than yesterday's high, and today's high was lower than yesterday's high, and today's low was higher. So all of the trading occurred within that range. We didn't make a higher high than we made yesterday, and we didn't make a lower low. But we are stuck below a pretty key level here near term on this 30-minute time frame, this 109 level. We're stuck below that. These are the levels we were looking at earlier in the week, was that 111.80, then 111. We gapped down through that. Then we came down to this 109 level, and now that 109 level, that prior level of support broken, tends to act as resistance. And the more time it takes to bounce from a level like this, it really frustrates more people, and it becomes more likely that the market breaks back down into the direction of the trend on the bigger time frame, which here with the declining 5-day moving average suggests that it's more likely to decline than it is to reverse. So what would change our mind? Well, if we got above 109, 109.10 and held there for maybe a half hour or so, maybe we get a short squeeze that creates a lower high up near that 5-day moving average, but it seems most likely that we really have to go into next week with a very cautious stance in the S&P 500 and in the NASDAQ. The NASDAQ, for its part, the lower part of that range is down near about 43.5, and looking at the weekly time frame, and I guess I've had these lines still on there for a while, the 38.2% retracement will get this market down towards about $41 a share. So another still close to 10% away. So there's still some real danger that we could see another little panicky wave over the next couple weeks. When we get these big red candles like this, they typically don't show up just one at a time. Sometimes they do when we're in a nice, solid, healthy uptrend with all the rising moving averages. But when we have the moving averages crossing back and forth and they're flattening out to turning lower like we have now, this is really an ominous looking candle for next week and suggests that you really have to be cautious with the NASDAQ. It seems likely, most likely to me, that we would head down towards 43.5. What would change my mind on a short-term basis would probably be getting maybe back above 45.30 or so. But these prior levels, what we have here is we have these lower highs and lower lows. So these prior highs are going to tend to act as resistance. If it makes it up through 45, then let's see if it could possibly get up to this prior support, which did act as resistance yesterday. So what's most likely doesn't mean what's definitive. Nothing is definitive in fundamental or technical analysis. There's uncertainty in everything that we do, which is why risk management is always job number one. Now, the Russell 2000, again, this market is relatively much weaker here. Year to date, through yesterday at least, was only down 1%, but for the month we were down 5%, and so we've got what had been this range. We came up, tested it, and we broke those trend lines, of course, and those key levels of support. And this was one that I've had drawn in since, I don't know, maybe Wednesday, I suppose. But that key level of support at 64 was broken. And if you didn't respond quickly to price action, if you said, well, I'm going to wait for a bounce, I'm going to wait for it to close that gap, like people are looking to close this gap, not all gaps get filled. Eventually, over the next decade, they probably all do, but these gaps are really a big warning sign that there is something severely wrong. This isn't 100 share orders rushing to the sidelines. This is big emotional institutional money. Don't think again that all institutions, just because they control $100 billion or whatever the number is that they're any smarter than you or I. They simply are not, and they don't have the advantage to react quickly. It's not easy to get rid of 5 million shares, 1 million shares, or whatever, and we're seeing some real serious pressure in terms of the downside, these lower highs and lower lows. Now, we got a little reactionary on Thursday morning, and we experienced a bounce. And when we're below a declining 5-day moving average like this, it's okay to look at those and trade them. There's some great day trade opportunities. So yesterday, we had our let me just get rid of that, because right now it's just more of a distraction than anything, the volume by price. But yesterday, here was the VWAP for yesterday. Now it turns into 2-day VWAP. But we had some nice bounces from there and some real nice tradable little intraday flags. And it's okay to trade those. But when you're, again, the point I'm trying to make is when you're below this declining 5-day moving average, then rallies or any rally attempt should be considered guilty till proven innocent and only looked at from a day trading perspective. Now, when the 5-day moving average starts to kind of flatten out a little bit more, let's just back it up here and look at when it starts to flatten out and we get above it, that's a different story. But when we're below a declining 5-day moving average, these rallies, guilty till proven innocent, and you can see that there still remains pressure on this market with these lower highs. And today we had a lower low, but not from yesterday. That is, the afternoon we basically closed in the Russell 2000 right down at the lows for the day. We got a little bit of a bounce and a little program there that accounted for that big volume, but it's a weak market. A lot of people are looking at this and saying, hey, the Russell's at support, and a lot of people I realize like to buy support. For me, the more times support is tested, the more likely it is to fail to hold. However, a lot of times this isn't a surprise to see a bounce from there, because the sellers kind of stand to the sidelines and say, wait a minute, let's not sell after we've already been down 6% this week. Let's instead wait for a little bit of a bounce, and then you get some bargain hunters to come in there. It bounces a little bit, the shorts get squeezed a little, the buyers kind of get their little rush and in their profits, but then a lower high in here and then a break of that level could make the Russell 2000 very ugly to come down and test these levels and head to the 50%. And who knows, there's no saying that we can't head back down and do a 100% retracement of this. The economic news obviously continues to be horrible. There's unusual uncertainty in everything. Everyone, that's the new buzz phrase, kind of like the irrational exuberance. But this market is broadcasting real signs of trouble, and that's from a longer term standpoint. Now, we've obviously had a lot of volatility this year. I can't tell you how many times I've seen that little spreadsheet I post at the end of the day, the year to date column, go from red to green, back to red, back to green, as we've here's basically where we closed last year. How many times have we closed, moved above and below that, and more in particular in the S&P 500? That if you take a look at where we closed out last year, right here, how many times, and on the daily, this is the weekly time frame, but on the daily, back and forth above and below that, a lot more. But volatility, the tops aren't created all at once. Derek Hernquist just put a great article up about the slower nature. I'm butchering what it was about because I skimmed the article, but I retweeted it, so go take a look. But about the kind of the slower nature of how things change, that you get a shock. That doesn't necessarily mean this one shock is the end of the bull market. There's still good rallies in there, but it takes time to distribute and the sellers to really take control of this market. And it seems as though we're getting a lot more evidence that the sellers are taking control of the longer term trends, and it's really becoming pretty scary. Now, I don't want to emphasize that so much, because who knows, maybe we get down to 55 and then we begin the bull market of a generation because something changes. Right now, no one knows what that catalyst will be, but a bounce up and then a decline would be pretty hurtful to this environment. And the semiconductors, like I said, they're down at the bottom end of that range. They had a very difficult week, losing what percentage is this, I guess. My spreadsheet's not up to date until afterwards, but close to 8% on the week. So again, you ask yourself, what's most likely, but be prepared for anything. And then you want to say, well, does it make sense to sell short after the market has already dropped 8% in a 1 week period? Not necessarily the most educated shorts. Doesn't mean it can't work. So maybe some consolidation and a bounce is more likely, but when we look at a 10-minute time frame, for instance, there is absolutely zero evidence that the buyers are stepping up in any significant way, and these semiconductors closed right on the lows for the week here, tying basically Thursday's low, and that pattern of lower highs and lower lows is just as crystal clear as can be underneath a declining 5-day moving average. So even though it looks like it should be finding support, don't be one of those people that gets involved early and buys that first little bounce. And because at the end of the day, you feel like a jerk for buying it. You're buying it at 26.10, thinking, "Hey, there it goes. It's above VWAP. It's going to run." And at the end of the day, you're down 45 cents on a $27 stock. That's just it's a crummy feeling to go into on the weekend. Instead, focus on what's the intermediate term trend, and realistically, as I always say, I think the direction of the 5-day moving average really does the best job of that. And when the 5-day moving average is flattening out, then you look at it and say, well, what's the bigger picture? Well, if we could have gotten above that 28, then we might have had a squeeze, but instead we gapped down and broke the lower end of the range, and it's setting up much bigger trouble. 25 looks highly realistic. Now, we have a lot of trading that occurred in there, so maybe we just drop down to 25 next week, then begin that bounce before maybe the next leg lower takes us to the 50% retracement. You can see very little activity occurred basically between 24.5 and 22.5. So that seems likely, but does it seem likely right now for Monday to sell short this weakness? Well, it depends on how aggressive you are with your stops. Are you willing to take these very short-term close stops, and that comes down to your individual personality and trading style. The financials have been, we ruined this what was looking like a potential for an inverted head and shoulders pattern reversal. It broke briefly, and from that failed move came this fast move. Now we're back down to the bottom end of this range. Is this the best place to be selling short after a decline that's already occurred? Generally speaking, not really, but maybe it does this time. The weekly chart for the financials is a similar mess. But maybe some further consolidation in here. Then we drop down to in here. The financials still haven't seen the 38.2% retracement down towards that $12.80, $13 level. That looks like a very reasonable expectation at this point, unless the market reverses. But it looks like a very reasonable expectation for this market over the next several weeks or so, and that's the basis from which your positions really should be initiated, I think. So anyways, let's take a look also at Desi Finance asked me a question. I'm just going to read that earlier. When you chart futures, would you exclude the after hours data since your videos don't include after hours for stocks? And Desi, you know what the thing is? I'll show you what I look at during the day, what I have on pre-market. Is this 1 minute chart of the ES. I don't even have the volume on there. I'm more interested in levels and the volume weighted average price. But what I do is I do use the overnight information as well, because I want to have a reference point as far as where was support overnight, and that's where we found resistance. So this is from midnight last night, and a lot of times I like to just kind of see how are the E-minis responding to the volume weighted average price versus the SPY. So let's just take a look at those close together. Yesterday was actually a better case of this, but let's just take a look in here. So you can see now they're generally going to be in approximately the same spot. That is the volume weighted average prices. However, the white background stinks with this yellow pencil. But I do look at it because, but I don't place as much emphasis except on the nights or the after hours sessions where we might have had a bigger range and there was more volume that took place. But even still, if I put volume on this, and I'm sure you know this, but 95+% of the volume is going to occur. If we have an economic number at 6:30, 8:30 Eastern, between 8:30 Eastern and 4:15 p.m. That's 95% of the volume. Occasionally, you get something weird to happen, and you get a big emotional response, like we had seen in the ES the prior day, and so we had that big downward movement. That was the gap basically for the market, and then the S&P rallied up the futures. So I do include that's the long version of an answer to your question, which is, do I include the after hours? And I only look at the E-minis really on a 1 minute chart for that one day, because when you start looking at the E-minis, for instance, on a daily chart, well, we have rollover over 3 months, and then they adjust for for the dividends and the time value and all that sort of thing. So that's just my way of doing it. It's not necessarily the best way. I don't trade the ES, so maybe I'm not the best person to ask that to, but I like to look, when it comes to the E-minis, I like to look at both just to make sure that I'm not missing something, I guess. Blue Felder, Doug, Long Horizon, Market Heist, everyone, thanks for those retweets. Darren also made it back from the pool in time just to watch this. Darren, you should have stayed at the pool and caught the recording, but I appreciate it. And Jim Salvo also, thanks. Phil, and Weekly TA, who does some great work, John Lee, and of course Derek too. So I don't see anyone asking any questions. Have to agree with finance trends today, and have to agree with alpha trends. Looked at SMH, XLF, SPY. Market looks in danger of rolling over Ciudadano. I think that means caution in Spanish. I'm going to take my high school Spanish and think that I got that one right. How about I look at ACAS for BATA 44? ACAS is kind of similar to a lot of stocks. That it's a stock that I was looking at this week. It's really in this bigger triangle, really. It looked like, hey, it's getting back above the 10, 20, and 50-day moving average. They're all rising. They're above the 200-day moving average. It really needed to break this resistance in my mind to get going, but it's broken. I think it had its chance. And if you look, even just look at some of these stocks that begin with the letter A, there were a lot of stocks that looked like maybe they were going to get going. ACOR broke some resistance here on a gap, was above a rising 10, 20, and 50-day moving average, looked like a nice little consolidation, and then it got splatted. ACXM, and these are just stocks with a, that begin with an A. They have, or was it AEIS? Here's one that I was looking at this one earlier in the week because it has this longer term, what looked like a real nice longer term breakout on the weekly time frame, and you look at it, and what happened? Well, it broke out, was a nice pullback initially, then it had this next move higher, and looking at a short-term time frame, it then broke that 5-day. Well, let's look at a 30-minute time frame. It broke that 5-day moving average on a gap. The 5-day moving average acted as resistance, and then lower highs and lower lows. And when you go back to the weekly time frame, now we have a failed breakout attempt, very similar to the Pacific Energy or Public Service PEG that I was looking at a couple weeks ago. This one had a dividend of 4.5%. Looked like it was breaking out, and this is the danger of buying dividend stocks. I was talking actually with Derek Hernquist about this today, that we're talking about a company that that advertises buy dividend stocks on margin, because margin is real cheap, and you can kind of basically be like a hedge fund and earn the spread. Well, come on, I mean, if you're buying a 4% dividend and you buy the breakout and you don't have a stop in place, well, now all of a sudden you're down 10%. It's going to take you 2.5 years to break even with those dividends if the stock doesn't continue to go lower. Dividends, you can't just buy a dividend just because it pays a good yield. We traded this AONE last week. The AONE is a stock that people have been I see people on Twitter all the time, getting excited every time it rallies, and it's done nothing but break hearts. Finally, the stock got above its rising 10, 20, and 50-day moving average. We traded it right over in here and got stopped out that very same day. We bought it right here, got stopped out that day with a small gain, and look at how it has just been destroyed. I mean, you have to move quickly in this market. These stocks are just not holding bids, and again, there's just longer term. AIG was looking like, hey, it's gotten past that 40 level, looking like maybe it should go to 45. Instead, what happened? Well, AIG, let's take a look at that 10-minute time frame. Actually, AIG gapped down, broke that 5-day moving average, and just turned into a piece of garbage, which most people think it is anyways on a fundamental basis. So I could go on and on and on here with stocks that have failed. We can look at some that maybe are setting up. Look at healthcare, UNH, for instance. United Healthcare, the daily chart, it broke some resistance here. Nice little pullback. That was a little bit heavier volume than you would want to see it pull back on, though. But if it can maintain in here, hold on to this prior resistance as support. We've got all these moving averages rising, but on the 10-minute time frame, not yet. It's not time to buy this stock yet. It's still, we've had that decline, and it unfortunately came down on heavy volume. So we could take a look at something like the volume weighted average price from the move, which we could say began right here with this gap. And, since that gap higher on this day, the average price has been $32.50, and that's right where the 5-day moving average is. So maybe this flattens out. The 5-day moving average, that is, flattens out. The stock kind of turns sideways, maybe creates a higher low, and then breaks out. Then United Healthcare might be a good play for next week. Or keep your eyes on Humana, which is the same group. And the weekly chart. Look at this weekly chart on Humana. It looks like it's ready to break out and go fill in this big hole. Well, what is the market saying? We had a nice rally in here, volume, pull back in here. You could say, look at the VWAP in here as well, and say, well, that move really began at that point, so maybe they're holding on. Take a look at Fibonacci, and you use all these little pieces and say, is it holding up? So Humana seems to be holding up nicely. Maybe if Humana can, not get dragged down by a larger sell-off that might be coming in this market next week, that maybe Humana breaks this resistance, which turned into support and is now resistance. You get that, another day of consolidation will be best. That'll get that 5-day moving average flattened out. You buy that with a stop under here, and then you've got an uptrend on the short-term time frame, which is in alignment with the trend that is clearly higher here now on the daily time frame. We broke a new high, and the weekly time frame, we've got a very nice looking pattern, which looks like it has the potential to run, but it's just potential. Again, we want to assess what's most likely, but be prepared for anything. Anticipate all potential scenarios, but wait for price action before we actually participate. So anticipation and participation, different things, and it's patience and discipline that get you to take a look that separates whether you're going to be successful, especially in an unforgiving environment like we have right now. That was the point of looking at those stocks that got punished, and they were just stocks that had began with the letter A. There's a lot of them in other groups as well. Obviously, there's a lot of punishment happening here, so you want that confirmation before getting involved. How about a look at Jamba Juice, and this will be the last one for Bluey Huey. The weekly chart, it tried to break out. It looks like it failed to me. Jamba Juice doesn't look like it's got anything good going on in here. You look at a daily chart, it's making lower highs and lower lows. Below a declining 50-day moving average. We're just starting to see maybe signs that it's accumulating, but to me it looks neutral at very best. But we've got a move that you look at Fibonacci and say from this low of this year to the high of this year, we've retraced like 90% of it, which is basically a failed move. I think that Jamba Juice looks like a waste of time. It probably needs to turn sideways. If they didn't scare you out after the drop of 50% here in the last several months, if they didn't scare you out, then they're likely to wear you out as it turns sideways in here. And maybe that's your game, is you don't mind holding for a longer term, but it just looks to me kind of like a waste of time. And I just saw the best comment of the day from Dan Conway, which says, "Thanks, Brian. Now go hit the neighborhood pub." I think after a bike ride, that sounds like a fantastic idea. Thanks for tuning in, everybody. Have a great weekend, and we will talk again next week.